All right, guys, what's up? We're back with another Why as Well today. Today we're going to be we're starting the macroeconomics, which are extremely important to understand like your finances and your investing, and it's extremely important to know for just life. So, first macroeconomic topic we have is interest rates. Now, what are interest rates? Well, essentially, they're a percentage that represents the additional cost of borrowing money or the additional return on your investment. So in APR, you might see like on a home loan, the APR, which is the annual percentage rate, which is how much percent of the principal you're going to have to be paying per year. So in APR or the interest rate on borrowing money, you might see a car loan. So a car loan of 30K and the APR is say, I don't know, 5%. Or you can have an APY. An APY is the annual percentage yield. These are two different things. Annual percentage rate is how much you pay. Annual percentage yield is how much money you're going to be getting. So, annual percentage yield, the interest rate on saving or investing money, such as a CD account. You might see an APY of 5% on a CD account. It's important to keep in mind that APR and APY are two different things. APY is good. APR is bad. You want a low APR. You want a low APR and a high APY. Now, interest rates apply to most borrowing or lending transactions. So either you're borrowing money from the bank or you're lending money to someone, probably going to be lending money to a bank. And here are just some pictures. Now, we have different types of interest rates. The first one we have is a simple interest rate, which you can calculate by multiplying the principal, the interest, and the time. So, for an example, you take out a loan for $200,000 at a 4% interest rate. Now, 200,000 times 4% is going to be $8,000 a year, right? Because the APR, annual percentage rate, is 4%. So you're going to be paying 800K. No, sorry, you're going to be paying 8K a year just in interest, right? Because you're going to have to keep in mind, you're going to have to be paying back the principal too. Because you take out a loan for 200K, that means you don't have 200K. So you're going to have to be pay back the 200K plus 8K a year, right? So if the loan is for 20 years, what's 8,000 times 20? $160,000. So if you take out a 200K loan and you plan on paying it back over 20 years, so you plan on paying 10K a year plus the 200K, on top of that, you're going to also pay $160,000 just off the interest. So when you pay back the loan, you're not going to be paying back $200,000. You're going to be paying back $360,000. And the second interest rate we have is a compound interest rate, which you can see the formula there. P equals the principal, and N is the number of compounding periods. So, for example, you take out a loan of $10,000 at a 5% annual compound interest rate for 3 years. Now we have 10,000 times 1 plus 5%. The little caret thing means this thing right here means to the power of. So you take that and the power of n, which our n is 3 years, right? So you have 10,000 times 1 plus 0.05 to the power of 3 minus 1. What does that get us? $1,576.25. Now, it's important to realize here, when you're borrowing money, you don't want a compound interest rate, because what does that mean? Over time, the interest rate is going to become more and more and more, and you're going to have to be paying more and more, right? When you're investing money, you do want a compound interest rate. So when you're borrowing, you want a simple interest rate at the lowest possible rate, and when you're investing money or saving money, you want the highest compound interest rate. Now, obviously, interest rates are for a reason, right? Why would they be charging you interest? Well, one, they want to make sure that you're going to pay back a loan, and two, the banks, they're companies, right? They're businesses. They need to make money too. So how do they make money? So, for example, say a bank gets a deposit for $300,000 to put into a CD account at a 5% annual percentage yield. The bank will then take some amount of that deposit. So, for this example, let's say they take $200,000 and they're going to loan it out to someone else at a higher interest rate, annual percentage rate, not annual percentage yield, percentage rate at 7%. So, the bank, right, since you put in your money, they must pay you, since you put in your money to the CD account, and the interest rate of the CD account is 5%, right? The bank is going to have to pay you 5% of your initial deposit of $300,000 for however long the term is, right? So the bank must pay 5% of the original $300,000 to the CD account, but the bank is getting paid 7% on the $200,000 loan. So essentially, the bank is netting a 2% interest rate, which is how they profit, right? They give out a low interest rate and they demand a high interest rate to be paid back. Now, how do they do this? Well, they're banks, right? Like taking J.P. Morgan and Chase, for example, they have hundreds and hundreds of thousands of clients, and some businesses are borrowing hundreds of millions of dollars from them. So this might not look like a lot, but when you have hundreds of thousands of people and that billions and trillions of dollars circulating, they just rinse and repeat this, and it's very lucrative business. So that's essentially interest rates. That's what's the first macroeconomic. And how are they determined? Well, you got the Fed, which is the central bank of the United States, which essentially set the interest rates. And based on this, the banks determine what range they can price their APRs at. When central banks set the interest rates at a high level, the cost of debt rises, which means high cost of debt. People are not going to want to spend as much, and they're not going to want to borrow as much, which means less spending, which means slower consumer demand. And to combat inflation, the central bank will raise reserve requirements, which is essentially how much money the bank is required to keep from the lender. So for example, say you put $100,000, they're required to keep. I don't remember off the top of my head. I think it's the normal is like 20% they have to keep. So off your 100,000, they will lend out 80,000 and they would keep the 20,000. Now we'll do a different video on that. We'll do a video on like banks and how that all works and the how they multiply cash. But for now, that's all you need to know. And in a higher interest rate economy, people will save more because they want to get a higher return on their investment because the interest rates are higher, right? So higher APY. And they also want to not spend as much because the interest rates on loans are also going to be higher, right? So why would you want to take out a loan with a high interest rate when you could put it in and get a high interest rate back on your money? Now, a lower interest rate obviously is going to have the opposite effect, right? Lower interest rate, people want to borrow more since it's cheaper, which equals more spending, which then drives up the price of the whatever businesses, stocks, whatever you want. It stimulates the economy, right? And it's just an extra fact. Bonds usually react inversely to interest rate changes. Now, what's our overall here? Never take out a loan because they're a big ass scam. Ever. Never take out a loan. No, I'm just joking. But in all seriousness, you must make sure that you take into account how much interest you'll be paying on the loan because the first example we did, you saw that the loan was $200,000 and over 20 years, you wouldn't be paying back the $200,000. You'd be paying back the $360,000, right? So always take into account how much the interest rate is going to be on your loan and make sure you can afford the extra expenses. So for example, me personally, I would try to avoid a loan unless I had some sort of passive income. I wouldn't want to be paying off. This is just my personal opinion, not financial advice at all. But me personally, I wouldn't want to be paying off a loan with my active income, so with my like salary or whatever. I would want, I would only take out a loan personally if I had a passive income that could cover the expenses, the payments on a loan. So for example, if you had a rental property and the mortgage plus the interest was $2,500 a month, the mortgage plus the interest, so you'd have to be paying $2,500 a month on the property. I would only take out a loan if I knew the rent of that property could produce me cash flow. So if the rent may be $3,000, I would put 2,500 to the loan and I would cash flow the extra 500 into my pocket. So that's basically about interest rates. They're extremely important. Must know them for your daily life. You're going to use them not, I mean, probably every day to be honest, if you're going to ever buy a car or a house, but they're very important. So the next video we're going to do, I think, is going to be either inflation or the Federal Reserve. I don't know yet, but stay tuned for it. Thank you for watching.